Welcome, everyone. Are you curious about the exciting world of futures trading? Or perhaps you're searching for ways to diversify your portfolio and boost your earnings potential? Either way, you've landed on the right video. My name is Yu, Y-U, a professional trader with years of experience under my belt, and I've been navigating the tumultuous waves of the futures markets, particularly the E-mini S&P 500 futures, but also the Nasdaq, gold, crude oil, and some soybean as well. Just today, over a trading session of about 6 hours, I've managed to secure a substantial profit of over $15,300. Sounds impressive, right? This is not just a walkthrough, it is a deep dive into the critical concepts, the mindset, and the strategies that you need to thrive in the futures markets. We'll explore the intricacies of futures contracts, delve into key aspects of trading psychology, and discuss the practical tips for beginners looking to venture into day trading. Regardless of whether you're a seasoned trader looking for new strategies or a beginner trying to understand the ropes, this video is tailored to provide you with actionable insights and help you elevate your trading game. So, are you ready to embark on this enlightening journey with me? Let's trade better together. Don't forget to hit the like button, subscribe, and turn on the notification bell to stay updated on future trading adventures. Now let's dive right in. In the grand theater of financial markets, one instrument steals all the limelight with its potent mix of risk and rewards. This instrument is the futures contract. Beyond the glare of Wall Street, these seemingly arcane financial agreements ripple through our daily lives. They shape everything from the price of your morning orange juice or a cup of coffee to the cost of heating your home in the winter or cooling your home in the summer. Yet, the futures contract is more than just a conduit of price determination. It is a lifeline for businesses seeking stability amidst constant market turmoil, a crystal ball for investors peering into the future for stability and profits, and an accelerator for speculators hunting for profit, not unlike a professional hunter silently moving through a dense forest. The sportsman was intently tracking his prey. At its core, a futures contract is a straightforward concept. An agreement to buy or sell a particular commodity or financial instrument at a predetermined price on a future date. This simplicity, however, belies the powerful impact such contracts exert on global commerce and individuals' fortunes alike. The world of futures contracts may appear distant and complex, like a faraway galaxy in a remote corner of the universe. Like a nebula teeming with celestial bodies, each following its own mysterious path. However, with a firm grasp of their principles and mechanics, it becomes possible to chart a course through this financial cosmos. In this video, I will be your celestial guide, unraveling the complexities of futures contracts, exploring their diverse roles, warning you about potential pitfalls, and helping you, my audience, in demystifying their risks and helping you along your path to becoming a profitable trader. Ready your minds as we embark on an enlightening journey into the intricate universe of futures contracts. Fasten your seatbelts. The countdown has begun. We will be going faster than light, and we're ready for liftoff. Are you ready? Let's go. Briefly explain what futures trading is for the uninitiated. What is futures trading? And what are futures contracts? Futures contracts are financial agreements that obligate the buyer to purchase and the seller to sell an asset at a predetermined price and at a set date in the future. The assets involved can vary widely, ranging from commodities such as oil, wheat, gold, soybeans to financial instruments like government bonds, currencies, and so forth. Futures contracts are the crux of a world that pulses with financial speculation. What are these, you ask? Think of them as binding financial agreements, obligating a buyer to purchase and a seller to sell an asset at a fixed price at a fixed date in the future. Ever speculated on how the price of commodities such as oil, wheat, gold, soybeans, hogs, beef may fare in the future, tomorrow? Or perhaps in financial instruments like government bonds or currencies. That's exactly what these contracts are pegged to. So given this large range of assets, what particular commodity or financial instrument catches your eye in the futures market, and why? Futures trading is the practice of buying and selling these futures contracts. Day traders use futures contracts as a way to speculate on future price of an asset involved. If the trader believes that the price of the asset will rise in the future, they might buy a future contract now at the current price with the hope of selling it later at a higher price for a profit. On the other hand, if they believe the price will fall, they might sell a futures contract in anticipation of buying it back at a lower price later on. Let's talk about trading futures. Moving on to futures trading. This is essentially a buy or sell practice of the futures contracts. Have you ever tried to speculate on the future price of an asset? Tell me about your experience. How did it go? Were you profitable? How long were you holding? Did you go long or short? These types of questions help me understand your experience in the markets. Purchasing, buying, or selling these contracts, that is exactly what futures trading is all about. If you, as a trader, has a hunch that the price of an asset will go up or maybe skyrocket, you might want to buy the contract at today's price or right now, anticipating that you could sell it off for a profit after the price goes up a little or substantially. Conversely, if you foresee a price tumble, you might want to sell a futures contract right now, hoping to buy it back at a reduced price later. Have you entered into a futures contract? Did you go long? Did you go short? How did it go? It is important to note that futures trading involves substantial risk because the futures market can be highly volatile and because futures contracts are typically leveraged, meaning that traders borrow money to make trades, and the cost that you pay to enter a trade is substantially less than the actual price of the assets. Traders can potentially incur significant losses. Therefore, futures traders is usually recommended only for sophisticated investors who fully understand the risks. Have you traded before? Did you fully understand the risks when you entered your position? Do you know any type of risks that could happen for trading futures? Again, let me know. What's your experience here? Remember though, all that glitters is not gold. Futures trading is peppered with risks, and the risks are substantial. The market for futures can be turbulent, creating a high volatility situation. Since futures contracts are generally leveraged, you pay a lot less to enter the position. The ability to make profits is very high, but also the ability to make losses are equally as high. The borrowed money is a double-edged sword. It facilitates your trade, allows profits, but we also have to keep in mind that we can lose money on the trades, and we should always be careful. This means when you enter the market, you should always have a stop loss, which is a maximum you're willing to risk for any particular trade. And again, things like stop losses and how to enter are reasons why the futures market is only recommended for sophisticated investors. Now, if you aren't sophisticated yet, it is my goal to help you to understand all the risks so that you can know how to safely enter the market, take profit as an active speculator, and become a profitable futures trader. The allure of futures trading. Again, the allure of futures trading. Describe why futures trading is attractive to some traders. Potential for high profits, access to leverage, ability to hedge risks, etc., etc. I would say the number one reason most traders choose to trade futures is that there is no day trading restrictions. Unlike the stock market or options, there are no limitations on day trading in the futures markets. Traders can open and close positions as frequently as they wish, providing greater flexibility in trading futures contracts. Have you ever felt confined by the day trading restrictions in the stock market? Well, the futures market does not have this barrier. You can open and close positions as often as you like. This offers you the flexibility to make your moves when it suits you. Can you handle the freedom and quick decision making that trading futures markets requires? In the world of financial trading, few freedoms are as tantalizing as the absence of day trading restrictions. For those who thrive in the adrenaline-pumping landscape of swift, multiple trades in a day, futures trading holds a unique allure. Why is this? It offers traders the liberty to open and close positions as frequently as they want during the trading session, free from the limitations placed on the regulated financial markets. What regulations are these? For comparison, let's look at the equity markets. The Financial Industry Regulating Authority, or FINRA, impose what is known as a pattern day trading rule, PDT. This rule applies to stocks and options in the United States. According to this rule, if a trader executes 4 or more day trades within 5 business days, they are labeled as a pattern day trader. Subsequently, they are required to maintain a minimum equity of $25,000 in their trading account at all times. Yes, that's $25,000 at all times. This rule makes day trading less accessible to traders with smaller accounts, and this restricts the number of trades they can make within a certain period. Who has traded equities and had their accounts frozen because they accidentally hit the PDT rule? I think many traders have had this experience, and it is frustrating and it can be annoying. In the futures market, we don't have this rule. The futures market, on the other hand, do not carry such restrictions. A trader can open numerous positions in a single day without needing to maintain a hefty balance in their account. This freedom gives futures traders greater flexibility in managing their trades and responding to market changes. Want to capitalize on an emerging trend at a moment's notice? Futures trading allows you that freedom. Need to rapidly reduce exposure due to an unexpected market event? You could do so without concern for the PDT rule when trading futures contracts. Does this freedom to trade as you please without the shackles of the PDT rule attract you to futures trading? Or does the risk associated with such freedom give you pause? Some people will prefer the stability of knowing that they always have enough equity in their account to cover anything. Some people would like to trade on the edge. They don't mind the margin and the risk. Leverage. Futures trading allows for a high degree of leverage, meaning that traders can control large amounts of an asset for a relatively small amount of capital. This means that even small price movements can lead to significant profits or losses. Never forget that. Think of leverage as an amplifier of your investment world. It enhances your trading capacity, enabling you to handle significant amounts of an asset with just a fraction of the total value. However, I must keep advising you, with this power comes increased risks. Are you able to manage the potential ups and downs? We all know this is leverage, but do you know what it's called? The leverage that the futures market uses a different way to calculate risk. This is called span margin, SPAN. This is called span margin, SPAN, and it stands for Standard Portfolio Analysis of Risk Margin. Span margin, a key advantage for day traders. One of the key components of futures trading is the concept of margin, a deposit required to enter a futures contract as a guarantee against default. Again, span margin stands for Standard Portfolio Analysis of Risk Margin. It is a system that calculates margin based on a comprehensive assessment of one-day risk for a trader's account across various products and markets. Span margin was created by the Chicago Mercantile Exchanges, the CME, in 1988. Span margin is used by most exchanges around the world. It operates on the principle of risk-based margin, which accounts for multiple factors, including price volatility of a futures contract, other positions within a trader's portfolio, and their potential to offset risks. Now, how does span margin offer benefits to the trader? Span margin has efficient use of capital. Unlike securities and equities trading, where a trader needs to have a significant amount of capital in their account to undertake multiple trades in a day because of the PDT rule, pattern day trading, span margin allows a day trader in the futures market to control large positions with relatively small amounts of money. This can lead to more efficient use of capital, thereby providing higher potential return on investment. Lower margin requirements for hedge position. Span margin takes into account the entire portfolio of a trader. If you have offsetting positions, which is common in strategies employed by day traders such as spreads or straddles, span can recognize the lower risk associated with these strategies. As a result, reduce the margin requirements. Intraday margin benefits. Some brokers may offer lower day trading margin, which are a fraction of span margin requirements. This can further reduce the amount of capital required to enter positions, thereby making it easier for day traders to take advantage of intraday price movements. Intraday margin benefits. Some brokers may offer lower day trading margins, which are a fraction of the span margin requirements. This can further reduce the amount of capital required to enter positions, thereby making it easier for day traders to take advantage of intraday price movements. However, it is important to remember that while span margin can allow for more flexibility and capital efficiency for day traders, it does not eliminate the risks associated with futures trading. The leverage that comes with margin trading can magnify both profits and losses. Day traders should have a strong understanding of how span margin works, as well as solid risk management strategies in place to navigate the high risk, high reward landscape of futures trading. What are your thoughts on the benefits of span margin for day traders? Does the efficient use of capital outweigh the potential risks? I'm interested in hearing your opinion on it. Do you prefer span margin of the futures market or the FINRA-based margin of stocks, options, and equities? Hedging opportunities. While this is not something that most day traders take advantage of, businesses that need certain commodities in the future use futures contracts as a hedge against unpredictable price fluctuation. This reduces the risk of price changes between now and the delivery date. This allows businesses to lock in a minimum price for their products if they're selling, or it could put a roof on the maximum price they're willing to pay by locking in the price now. So this allows greater flexibility and gives the business some semblance of stability into the future. Have you ever wished for a crystal ball to predict the future of market prices? Futures is a way to achieve this. Futures contracts are the next best thing, serving as financial safeguard against volatile price movement. It is akin to financial armor, protecting your businesses from unexpected shocks. If you're a business, have you ever considered how hedging could secure your operations? I'm curious to know. So anyone watching this video, a business that uses futures contracts as a hedging strategy to limit losses, lock in some particular price in the future, or any other way a business might use a futures contract? I'll be interested to hear about it if you let me know. Liquidity. Many futures contracts, such as those for commodities like oil or financial instruments like the S&P 500, are extremely liquid. This high liquidity makes it easier for traders to enter and exit positions. Picture high liquidity as an open, free-flowing river, permitting smooth and swift transactions. Some futures contracts, like those for commodities and major financial indices, offer this advantage. With the ability to jump in and out at your leisure, how might this fluidity transform your trading strategy? This liquidity of the futures contracts is because all futures contracts are standard. The futures market uses standardized contracts. This means that the specification for each contract, such as the quantity of the underlying asset, the delivery date, and the price increments, are all set by the exchange. This standardization makes the contracts interchangeable or fungible, and thus much easier to trade. Because you could always trade like for like. They are completely fungible. 24-hour markets. Many future markets operate nearly 24 hours a day, which can be attractive to traders as it allows them to react to global events and changes in the markets immediately, rather than waiting for markets to open. The sun never sets in the futures trading world. Thanks to the near constant trading windows, when global events cause market tremors, you can respond instantly. How could a 24-hour market cycle empower your trading decisions? Do you see any downsides associated with a 24-hour market? Speculation. For those inclined towards speculation, futures offer potential for substantial returns. Because of the leverage involved in futures trading, traders have the opportunity to make significant profits. If their predictions about future price proves correct, then they can make a lot of money very quickly. For those who find a thrill in taking calculated risks, futures trading provides an exciting platform for speculation. Can you navigate the roller coaster of market predictions and turn volatility into victory? Speculation is essentially the practice of making directional bets on the future price of an asset, with the aim of profiting from price changes. In the context of future trading, a day trader can use speculation to potentially generate substantial returns within a relatively short period of time. A few benefits of speculating on futures are potential for quick profits. Due to the fast-paced nature of day trading, speculators can potentially make significant profits within a single trading day if their predictions are correct. No ownership required. With futures, you're speculating on the future price of an underlying asset without needing to own it. This means you can speculate on price movement in either direction, up or down, without holding for delivery. Now, while these are some of the benefits of speculating, there are also some downsides. Here are a few downsides of speculating on futures prices. There's always the potential for a large loss. The same leverage and span margin that can amplify your profits can also lead to significant losses. If the market moves against the trader's position, it is important for day traders to use risk management strategies, such as a stop-loss order, to protect themselves from even greater losses. Day trading futures requires significant skill and knowledge. Successful speculation requires a deep understanding of the markets and the ability to analyze a variety of information quickly. Without this, a day trader is essentially gambling, which can lead to substantial losses. Emotional stress. Day trading can be highly stressful, particularly when speculating on high-risk, high-reward trades. This emotional toll can lead to poor decision-making and ultimately trading losses. Overtrading. The potential for quick profits can lead to overtrading, where traders make more trades than they probably should in the hopes of achieving greater profits. This can increase transaction costs and potentially lead to poorer trading decisions. Diversification. Futures can provide an additional layer of diversification to an investment portfolio. Because futures contracts are derived from a wide range of underlying assets, they can help spread out the risks of these underlying assets. Imagine your portfolio as an art piece, and futures contracts as splashes of vibrant color, adding complexity and depth. They disperse risk and help make your financial standing resilient. Could a touch of futures trading be a key to perfecting your financial masterpiece? Transparency and price discovery. Futures markets are known for their transparency. The prices of futures contracts are determined by supply and demand dynamics. In the market, the price of futures contracts are determined by supply and demand dynamics in the markets and are considered to be an indicator of the expected future price of the underlying assets. In the open book of futures markets, every page is available for your perusal. This visibility provides a fair and even playground. Do you see yourself striving in such an upfront and straightforward environment? Let's talk about leverage risk. Leverage can amplify both profits and losses. A small price change in the wrong direction can result in significant losses, possibly exceeding the initial investment, due to the high degree of leverage involved in futures trading. Leveraged trading often involves borrowing capital to open positions. If the market moves in the wrong direction and your account balance falls below a certain threshold, you'll face a margin call. This means that you must deposit more money or close out your positions to meet the margin requirements. Ever had to suddenly come up with cash for an unexpected expense? Margin calls are the trading equivalent of those, and they can force traders to make hastily suboptimal decisions, which, if you had proper risk management or enough capital, could have gone in your favor. So it's important to remember, avoid margin calls at all costs. Have you ever been in a situation where you were faced with a margin call? What actions did you take when you were faced with a margin call? Looking back, would you handle the trade any differently that caused you to have a margin call based on your experience? Another pitfall of leverage is that leverage can give you a false sense of security by making it seem like you're using free money. However, it is crucial to remember that any losses incurred on leverage trades need to be paid back. It's like using a credit card. It might feel like free money at the time, but you'll eventually have to pay the piper, and repaying the leverage is no fun. Have you ever felt a sense of overconfidence when trading with leverage? How do you keep your emotions in check and ensure that you're not succumbing to the illusion of free money? Do you have a strategy or approach to handle the psychological aspects of leverage trading? Another downside of trading futures is market volatility. The futures market can be extremely volatile, and it can become volatile suddenly with no prior warning. With price fluctuating rapidly, such volatility can lead to substantial losses in a very short period of time. We've all seen the market make insane moves, both up and down, and sometimes up and then down and back up within a very short period of time. We should be aware of these risks and always use a stop loss when entering the market at the minimum. Another risk closely related to market volatility is liquidity risks. While many futures contracts are highly liquid, some are not. Low liquidity can make it difficult to enter or exit positions at a desirable price, which could result in losses. Sometimes traders call this slippage, where they choose to exit the market. They think they're exiting at one price, and the price they actually exit at could be substantially worse, and they say the price slipped or it's slippage. Or sometimes we've seen where the order book will become empty. All the buyers and sellers will start to pull their orders, and the order book starts to look like a wasteland where all the major sellers and buyers pull their orders, the book becomes empty, and the price will slide around because there's no orders, no one in the market to fill at certain prices, so the market will keep going until it reaches the exhaustion point, where it suddenly retraces without a lot of warning. So if we're ever in the market and we notice the order books start to thin out, we should take this as advance warning that There is a major news event that's about to occur, and you most likely do not want to be in the market at this time. Wait until the order book thickens back up, and then we can continue our trading. The risk of default. The risk of default. There's a risk that the party at the other end of the futures contract may default on their obligation. While commodity futures are often backed by physical assets, this is not the case for all types of futures contracts. This is relatively unlikely in a modern futures market, but it is important to remember that it could happen. And if it could happen, as traders, as sophisticated investors, we need to understand that there's a risk and we need to be aware of it. Regulatory risks. Changes in government regulations or policies can impact futures markets, potentially causing rapid price shifts. As day traders, we again should be aware of these risks. While they are uncommon, any risks associated with the markets we should be aware of because we are sophisticated investors, right? Therefore, we should have an understanding of all the risks, no matter how unlikely they are to occur. Overnight risks. Because futures trade almost 24 hours a day, it's always overnight somewhere. Now, typically, overnight risk refers to risks when it is nighttime according to the American Eastern Standard Time or Central Time. Overnight risks. Price changes can occur outside of the normal trading hours for Central or Eastern Standard Time. Traders may wake up to find that the market has moved significantly against their positions. It's something we should be aware of if we're going to have open positions and not paying attention to the market. Make sure if you're trading overnight, you're constantly watching, staying up to date, possibly right in front of the trading platform. Complexity. Futures markets can be complex. They require a good understanding of financial markets, financial instruments. Lack of knowledge can lead to substantial losses and costly mistakes. So be careful. Make sure you fully understand what you're trading and just be aware. Emotional and psychological risks. The intense pressure and stress associated with futures trading can lead to poor decision making. Whenever you enter a trade, it is almost like being put in a pressure cooker. The stress can be immense. There are a lot of psychological issues that we'll discuss going forward, but a few of them are fear and greed. These are very powerful emotions that will cause you to act irrationally and override well-planned trading strategy. We have to remember to keep these psychological aspect of our trading in order because it will be the hardest thing that you ever have to do. Common pitfalls for futures traders. Discuss some common mistakes made by futures traders, such as lack of preparation, failing to set stop losses, and not managing risk properly. Talk about the emotional challenges, the stress, fear, greed, and how they could negatively impact your decision-making process. Lack of preparation and education. Futures trading is a complex field that requires a strong understanding of the market and its dynamics. Many traders jump into futures without sufficiently educating themselves on the intricacies of the market, leading to poor decision-making. Over-leveraging. The use of leverage in futures trading can potentially amplify profits, but it can equally amplify losses. Traders who use excessive leverage may find themselves in precarious financial positions if the market moves against them. Neglecting risk management. Failing to implement solid risk management strategies is a common pitfall. This can include not setting stop loss orders, risking too much capital on a single trade, or neglecting to diversify their portfolio. Impulsive trading. Allowing your emotions to take over, emotions like fear and greed, to drive your trading decisions can lead to a rash and unprofitable actions. Traders must strive to maintain discipline and stick to their predetermined trading plan. Poor timing. Many traders try to time the market perfectly, buying at the absolute low and selling at the high. This is near impossible feat, even for seasoned traders. Attempting this often leads to a missed opportunity or entering trades at unfavorable prices. Ignoring the trend. The trend is your friend, as most traders say. Ignoring the trend is your friend, is a saying you'll often hear. It's a common saying in trading for a good reason. Ignoring the dominant market trend at the time and attempting to trade against it can result in losses. As you become more skilled, you'll understand how to trade against the trend. But for now, it's better to trade with the trend than trying to fight it. Imagine yourself as a fish trying to swim upstream. Is it impossible? No, but those fishes are usually mature with many years of experience, and they're returning home to a place that they've known their whole lives. And even with that, it's still fraught with danger, and many do not make it. So avoid trading against the trend. Overtrading. Sometimes the best action in the futures market is no action at all. Some traders feel compelled to constantly have an open position or to trade frequently. This can lead to unnecessary risks and losses. When you constantly open positions and close positions, there are costs associated with each trade. There are commissions and fees to make a trade. Therefore, a small profit might be no profit at all when all things are considered, and then you've amplified your stress. So it's better to avoid overtrading at all costs. Ignoring external factors. The futures markets are influenced by a range of external factors, including economic data, geopolitical events, and even weather patterns. Traders who ignore these external influences may find themselves blindsided by sudden market shifts. The consequences of uninformed trading. Describe real-world examples of significant financial losses and other negative effects caused by uninformed futures trading. Mention the potential for losing more than the initial investment and the resulting debt. Discuss potential impacts on mental health due to the stress and uncertainty. Trading in the futures market without an adequate understanding of how it operates can lead to severe financial consequences and potential emotional distress. This type of trading behavior, referred to as uninformed trading, is characterized by a lack of necessary market knowledge, inability to interpret and analyze market trends, lack of clear trading strategy, and poor risk management. Here are a few of the potential negative consequences of uninformed trading. Financial loss. The most immediate and tangible impact of uninformed trading is financial loss. The futures market can be volatile and unpredictable. Without a solid understanding of the market and well-planned strategy, traders can easily make misguided decisions, leading to substantial financial losses. Increased risk. Uninformed traders often neglect the crucial aspects of risk management in their trading approach. They might risk a large portion of their capital on single trades, use excessive leverage, or fail to utilize stop-loss orders. Poor decision making. Uninformed traders may have difficulty making informed trading decisions. They may struggle to interpret market trends and signals accurately, leading to ill-timed trades. Inability to make sound decisions can lead to frustration, stress, and more trading mistakes, which continue to amplify trading losses and stress. Psychological impact. Consistent losses and the stress of trading without a clear understanding take psychological toll on a trader. It can lead to a high level of stress, anxiety, and decreased confidence. In severe cases, it might lead to a condition known as trader's burnout, where a person becomes so emotionally exhausted and unmotivated they can no longer trade effectively. Reputational damage. If you're a professional trader, uninformed trading can lead to reputational damage. Consistent losses and poor trading decisions can undermine your credibility and standing in the trading community. Loss of opportunity. Uninformed trading can mean missing out on profitable trading opportunities. Inability to understand or identify these opportunities can lead to suboptimal trading performance. Safe trading practices emphasize the importance of education, practice, a well-thought-out trading plan. Advise potential traders to fully understand the product they are trading, the market conditions, and the risks involved. Educate yourself. Understand what futures are, how they work, the terms associated with them, and how they are traded. Familiarize yourself with the futures market, their volatility, and the factors that can influence prices. The more knowledge you have, the better equipped you'll be to make informed decisions. Have a trading plan. Every trader should have a clear plan that includes specific goals, the amount of capital to be risked on each trade, the risk to reward ratio, and the conditions under which to enter and exit trades. Having a plan provides a roadmap that can help you navigate the unpredictable futures market. Practice risk management. Never risk more than you can afford to lose. As a general rule, avoid risking more than 1 to 2% of your trading capital on a single trade. Use stop-loss orders to limit potential losses and take profit orders to secure profits when price targets are reached. Stay informed. Keep up to date with global and market news, economic calendars, and reports that could impact the futures markets you trade in. Monitor market trends and use technical analysis to guide your trading decisions until you learn to trade without them. Maintain emotional control. Trading can be emotional, but allowing emotions to dictate your trading decisions can lead to poor outcomes. Try to maintain emotional control, staying patient and disciplined, even during periods of market volatility. Use leverage wisely. Futures trading allows for the use of leverage, which can magnify gains but also losses. While leverage can enhance potential profits, it is important to understand that it also increases risks. Use leverage wisely and considerately. Regularly review and learn. Trading is an ongoing process and you have to stay up to date. Regularly review your trades to identify what worked and what didn't. Use this as a learning opportunity to refine your trading strategy and to improve your trading skills. Remember, every trader makes mistakes, but successful traders learn from their mistakes, while unsuccessful traders don't. Diversify. Diversification can help manage risk. By spreading your investments across different futures contracts, you can mitigate the risks associated with any single investments. Emotional toll on you and the ones closest to you. Introduce the concept of emotional toll in trading. Explain that futures trading is not just a financial investment, but also an emotional one, due to the intense pressure and constant decision-making involved. Stress and anxiety. Discuss how the volatility of the futures market can induce high levels of stress and anxiety. Investing in futures markets can be an adrenaline rush for many traders due to its inherent volatility. However, the same volatility can often lead to high levels of stress and anxiety. Understanding why this is the case can require a deeper dive into what makes future markets tick and why this can sometimes feel like a roller coaster of emotions for those involved. Understanding market volatility. Volatility in the futures market refers to the frequency and severity of price changes. High volatility means prices fluctuate rapidly over short periods, making the potential for profits or losses significant. This uncertainty can naturally lead to increased stress and anxiety as the stakes are high and the outcomes unpredictable. The emotional impact of volatility. With volatility comes turbulence. Each price swing can bring with it a surge of adrenaline, a moment of euphoria, or a pit of dread. The futures market operates nearly 24/7, meaning these emotional highs and lows can occur around the clock. This constant state of alertness can lead to a chronic stress, fatigue, and even burnout. Futures traders must always stay on top of market news and events, as these can directly impact their positions. Unexpected geopolitical events, changes in economic indicators, or shifts in supply and demand can all suddenly swing the market, making the trader's job a perpetual high-stakes balancing act. Coping with market-induced stress. The psychological toll of this stress can be considerable. It is not uncommon for traders to experience sleep problems, irritability, and difficulties in concentrating. Over time, these stressors can contribute to a more severe mental health issues like anxiety and even depression. Consequently, successful futures trading requires not just financial savvy, but also psychological resilience. Traders need to develop strategies to manage their stress levels and keep their emotions in check. This might involve setting strict trading hours to ensure adequate rest, diversifying investments to spread out risks, or seek the support of mental health professionals to develop effective coping strategies. In conclusion, the volatility of futures market can indeed lead to high levels of stress and anxiety. But by understanding the nature of this volatility and being proactive about managing its psychological impacts, traders can navigate these turbulent markets more effectively. But a key question remains: how do you handle the emotional toll of trading in volatile futures markets? Do you have any tips or tricks that you'd like to share with your fellow traders? Have you developed any coping mechanisms? What strategies have you used to help you stay cool and calm amongst the storm of the turbulent futures market? Let me know. Do you have any tips or tricks to share with your fellow traders? What strategies have helped you keep a cool head amidst the storm of the futures trading? What strategies have helped you keep a cool head amidst the storm of futures trading? Explain that significant financial risks and potential for substantial losses can create a constant state of worrying. Futures trading can be a high-stakes game where the potential for considerable profits exists, alongside the risk of significant financial losses. This duality creates a constant state of concern for those involved, with the specter of loss casting a long shadow over every decision. Walking the tightrope of financial risk. Futures contracts are derivative products, meaning their value is derived from an underlying asset. These assets can be anything from commodities like oil or wheat, or financial instruments like currencies or interest rates. While this offers a range of possibilities for diversification, it also introduces various sources of risks. One of the key features of futures contracts is leverage, the ability to control a large amount of assets with relatively small amount of capital. While leverage can amplify profits, it can also amplify losses, often significantly. In fact, it is possible for a trader to lose more than their initial investment. This ever-present financial risk can be a significant source of worry. The anxiety of potential loss. The futures market can be highly volatile, with prices fluctuating rapidly due to changing economic conditions, geopolitical events, and shifts in supply and demand. As a result, traders must constantly monitor their positions and be ready to act at a moment's notice. The stress of potentially losing a significant sum of money can create a persistent state of anxiety. Furthermore, due to the complex nature of futures trading, even seemingly minor errors or oversights can lead to substantial losses. This constant need to be vigilant and the high stakes involved can result in continual state of worry. Living with constant worry. The constant state of worry can take significant toll on a trader's mental and emotional health. This persistent anxiety can lead to sleep disorders, difficulty concentrating, irritability, and a host of other physical and psychological issues. Over time, it can impact a trader's decision-making ability, potentially leading to a vicious cycle of stress and poor performance. In conclusion, in futures trading, the potential for significant financial losses is always present, creating a continuous state of worry. The emotional and psychological toll this takes can be profound, impacting not only the trader's performance but also their overall quality of life. It is a tough balance to strike, isn't it? On one hand, you're aware of the financial risks and potential for substantial losses. But on the other hand, the lure of high returns can be irresistible, like a moth to the flame. How do you manage this tension? How do you cope with the constant state of worry and keep a clear head? I'd love to hear your strategies for coping. Talk about how this stress can affect a trader's decision making, potentially leading to poor trade choices. The high stakes pressure cooker of futures trading. In the high stakes world of futures trading, stress is an ever present companion. The roller coaster ride of price fluctuation, the constant need to stay updated with global news affecting markets, the requirement to act swiftly to lock in profits or prevent losses, all these factors can induce a significant level of stress and anxiety. Stress and decision making, a dangerous cocktail. When the stakes are high and the pressure is on, stress can greatly influence a trader's decision-making process, often to their detriment. The human brain under stress tends to make decisions based on emotional responses rather than logical analysis. Under stressful conditions, traders might succumb to various cognitive biases that leads to poor trading decisions. For example, the loss aversion bias can make a trader hold on to losing positions for far too long in hopes that the market will turn around. On the other hand, FOMO, or the fear of missing out, can make them enter trades too hastily without thorough analysis, out of worrying that they'll miss an opportunity to be profitable. The domino effect of poor trade choices. Poor trading decisions can lead to financial losses, which in turn heighten stress levels, creating a vicious cycle. This increased stress can lead to more poor decisions, and the cycle continues, potentially spiraling out of control. It is not uncommon for a trader to blow up their entire trading account due to a string of such poor decisions driven by stress and emotion. A balancing act. Stress management in trading. For a futures trader, stress management isn't just about maintaining their health. It is a critical skill for protecting their investments and ensuring their decisions are driven by analysis and strategy, not emotions. To break the stress decision cycle, traders need to implement solid risk management strategies, set realistic goals, attain a balanced lifestyle, and seek to continually learn and improve their trading skill. This isn't easy and it's a constant balancing act, but the best traders know that managing their stress level is just as important as managing their investment portfolio. Have you experienced the stress decision cycle in your trading journey? What strategies have you found effective in managing and maintaining clear logical decision making in the face of market volatility? Do you have any coping mechanisms for market volatility? Your experiences could provide invaluable insights for other traders navigating the same challenges. Fear and greed. Discuss how the two primary emotions in trading, fear and greed, can heavily influence a trader's behavior. The emotional tug of war, fear and greed in futures trading. Every futures trader is, at heart, a human being, subject to the full range of emotions that any other person experiences. However, when it comes to trading, two emotions often rise above the rest: fear and greed. These emotions, if left unchecked, can heavily influence a trader's behavior, often leading to detrimental outcomes. Fear, the ghost of losses yet to come. Fear in futures trading usually manifests itself in two ways: the fear of losing and the fear of missing out. FOMO. The fear of losing can cause a trader to sell their contracts prematurely at the slightest hint of market downturn, thus locking in a small gain or even taking unnecessary losses. In its extreme form, fear can lead to paralysis by analysis, where a trader is so afraid of making a loss that they miss out on trades altogether. On the flip side, the fear of missing out can cause a trader to enter into a trade without proper research and risk management or risk assessment, simply because they're afraid of missing a potential lucrative opportunity. This can lead to entering trades at the wrong time and being exposed to significant risks. Greed, the siren call of untold riches. Greed, on the other hand, is the emotion that lures traders into the illusion of quick riches and effortless wealth accumulation. It can lead to reckless behaviors such as not taking profits in a timely manner in hopes that the market will continue to move favorably. Traders under the influence of greed might also overlook the necessary risk management strategies like setting appropriate stop-loss levels because they're overly focused on potential gains. Greed can also lead to overtrading, where traders make more trades than necessary, hoping that more trades will equal to more profits. This often leads to increased transaction costs and potential losses. Mastering emotions, the key to successful trading. Understanding and managing these two fundamental emotions is key to successful futures trading. Traders must cultivate emotional intelligence and employ disciplined trading strategies to ensure their decisions are based on analysis rather than emotional reactions. It is crucial to remember that fear and greed are natural emotions and not inherently bad. However, unchecked, they can lead to poor decision making and potentially significant financial losses. Have you experienced these emotional influence in your trading journey? How have you managed to control fear and greed during your trading decisions? Your insights could help guide new traders who are grappling with these emotional dynamics. Explain that fear can lead to selling too soon or not taking enough risks, while greed can result in holding onto contracts for too long in hopes of greater profits. Balancing act, fear and greed in futures trading. Every seasoned trader knows that the futures market is as much a psychological game as it is a financial one. The complex interplay of fear and greed can significantly influence trading decisions, often pushing traders to act against their best interests. Understanding how these emotions function in the trading environment is critical for anyone who wants to navigate the turbulent waters of the futures market successfully. Fear, premature exits. Fear, a primal human emotion, can often be a trader's worst enemy. Fear of potential losses can result in selling futures contracts too soon, foregoing the possibility of higher profits in this scenario. Fear can lead traders to exit a position at the first sign of market volatility, even when the long-term prospects may still be favorable. Traders may opt for safer, low-yield trades, miss out on potentially profitable opportunities, or avoid entering the markets altogether. In essence, fear can lead to an overly cautious approach that fails to capitalize on the inherent risk-reward dynamics of futures trading. Greed, the overstaying guest. Greed, at the other end of the emotional spectrum, can become overly optimistic or risk-seeking in the hopes of achieving greater profits. As the saying goes, pigs get fat, hogs get slaughtered. The allure of potentially higher results can make traders forget that the markets are unpredictable and no uptrend lasts forever. Neither do downtrends. We should also remember that the market can stay irrational longer than we can stay solvent. Greed can also lead to excessive risk-taking. Traders under the influence of greed may overlook the important risk management principles such as setting appropriate stop losses or take profit levels, diversifying their portfolio, or following a disciplined trading plan. This could expose them to severe financial losses. Emotionally intelligent trading. Recognizing the impact of fear and greed is a step towards becoming an emotionally intelligent trader. By acknowledging these emotions and understanding their effects, traders can make more deliberate, rational decisions rather than reacting impulsively to market fluctuations. So, fellow traders, how have fear and greed influenced your trading decisions? Have you found effective strategies to conquer or counter these emotional responses and stay focused on your trading plan? Burnout. Futures trader burnout. Discuss the possibility of burnout due to the constant need for focus, decision making, and managing stress. Burnout in futures trading, the hidden risk. In the world of futures trading, we often discuss market trends, risk management, and profit margins, but there's an important topic that tends to get overshadowed: trader burnout. The relentless need for concentration, decision making, and stress management can take a significant toll on a trader's mental health, leading to burnout if not properly addressed. What is burnout? Burnout is a state of physical, emotional, and mental exhaustion caused by prolonged stress. In the fast paced, high stakes arena of futures trading, the continuous need for alertness and calculated decision making can rapidly deplete a trader's energy reserves. This is not just about the occasional bad day or week. Burnout reflects a chronic state of being worn out and emotionally drained. Adding to this is the constant stress associated with trading. The futures markets are known for their volatility, with price potentially swinging dramatically in a short span of time. The stress of managing these sudden changes, along with the fear of substantial financial losses, can create an incessant state of tension. Moreover, futures trading often requires traders to stay on top of a wide array of information, including market news, economic indicators, and financial reports. This constant influx of information can be overwhelming, adding another layer of strain and further contributing to burnout. The consequences of burnout are severe. It can impair cognitive functions, hinder decision-making skills, and even lead to detriments in physical health. For futures traders, burnout can translate into poor trading decisions, decreased productivity, and diminishing bottom line. Preventing and managing burnout is a critical aspect of a trader's long-term success and well-being. This includes taking regular breaks, maintaining a healthy work-life balance, practicing stress management techniques, and seeking professional help if necessary. Fellow traders, have you ever experienced signs of burnout? Would you know how to identify if you're in a burnout state? How did you cope with and what strategies did you use to recharge and maintain your trading performance? Sharing your experiences can help others identify and tackle burnout before it takes toll on their trading. Talk about the importance of maintaining a work-life balance, which can be difficult due to the almost 24-hour nature of many futures markets. The nearly 24/7 challenge: striking a work-life balance in futures trading. A key allure of futures trading is the virtually around-the-clock operations of many futures markets. The opportunity to trade nearly 24/7 allows traders to respond in real time to global events and market shifts. However, this constant accessibility can blur the lines between work and personal time, making it challenging to maintain a healthy work-life balance. A work-life balance is crucial for maintaining overall well-being. It's about creating a sustainable equilibrium between professional responsibilities and personal pursuits, be it family time, hobbies, or self-care activities. However, The 24-hour nature of many futures markets can make traders feel like they must always be on. The fear of missing out on a potential market move can lead to long hours in front of the computer screen, often at the expense of personal time and mental health. Moreover, the boundaryless trading environment can amplify stress levels. When trading sessions spill over into personal time, it can lead to a constant state of anxiety and hinder a trader's ability to disconnect, relax, and recharge. Over time, this relentless pursuit can take a toll on mental health, contribute to burnout, and even impact trading performance. Despite these challenges, maintaining a work-life balance in futures trading is not only important, but also achievable. Setting boundaries is a crucial first step. This could mean defining specific trading hours and resisting the urge to trade outside of these periods, except in exceptional circumstances. It is also beneficial to incorporate regular breaks during the trading hours. Short, frequent breaks can help to reduce stress, improve concentration, and prevent decision fatigue. Furthermore, prioritizing physical health through regular exercise, a balanced diet, and adequate sleep can enhance mental stamina and trading performance. Lastly, traders should not underestimate the value of hobbies and social connections. Activities that are enjoyable and fulfilling can help decompress, recharge, and maintain a positive outlook, ultimately contributing to a sustainable trading career. How do you manage maintaining a work-life balance in a 24/7 futures trading environment? Are there specific routines or strategies that have worked for you? Sharing your insights can inspire other traders to find their own balance in the fast-paced world of futures trading. Impact on personal life. Discuss how the emotional toll and time commitment of futures trading can strain personal relationships and affect overall quality of life. Navigating relationships, the personal cost of futures trading. In the high-stakes world of futures trading, it is not only the potential financial losses that demand attention. The emotional toll and intense time commitments inherent in trading futures can significantly strain personal relationships and influences one's quality of life. Being consistently immersed in the market dynamics can lead to a tunnel vision of sorts, where the primary focus becomes the ebb and flow of the futures markets. Traders may find themselves mentally preoccupied with their trades even when they are not actively trading, which can lead to feelings of emotional detachment in their personal relationships. The 24/7 nature of many futures markets and the always-on mentality it encourages can also mean that trading infringes on personal time. Weekends, holidays, and evenings could be spent glued to the trading screen rather than enjoying quality time with loved ones. This level of dedication can cause friction with partners, family members, or friends who may feel neglected or undervalued. Additionally, the emotional swings tied to the volatile nature of futures trading can ripple into a trader's personal life. The stress of a losing streak, the anxiety of a high-risk trade, or the excitement of a significant win can influence mood and behavior beyond the trading desk. This emotional roller coaster can make traders seem unpredictably or emotionally volatile to their loved ones, further straining relationships. The toll on personal relationships is just one aspect of how futures trading can impact the overall quality of life. The constant stress and preoccupation with the markets can overshadow other elements that contribute to a fulfilling life, such as hobbies, physical activities, relaxation, and social connection. Yet, these challenges don't mean that one cannot be a successful futures trader and maintain a healthy personal relationships. Open communication, setting clear boundaries, and ensuring dedicated quality time for loved ones are vital. It is also essential to have strategies for managing stress and practicing self-care. Maintaining a balanced lifestyle while pursuing futures trading requires conscious effort and ongoing adjustments, but With awareness and the proactive steps, traders can mitigate the emotional toll of trading, maintaining healthy relationships, and ensure sustainable and satisfying quality of life. What strategies have helped you balance your personal relationships with the time commitment of futures trading? How do you navigate these emotional highs and lows of trading without letting them spill over into your personal life? Your experiences could be immensely beneficial to other traders grappling with similar challenges, so don't forget to share. Discuss the potential for developing unhealthy habits or dependencies as a coping mechanism for stress. The slippery slope, unhealthy coping mechanisms in futures trading. While the intensity of futures trading can be exhilarating, it also brings with it an immense amount of stress. If not properly managed, the stress can lead traders down a slippery slope towards developing unhealthy habits or dependencies as a way to cope. In the high pressure, high stakes world of futures trading, the temptation to turn to quick stress relief methods can be strong. Some traders may find themselves resorting to unhealthy eating habits, excessive caffeine or alcohol consumption, smoking, or even the misuse of prescription or recreational drugs. These behaviors may initially appear to provide relief or distraction from the pressures of trading, but they are typically short-term fixes that can lead to long-term health problems. For instance, a trader may rely on caffeine to stay alert during long trading sessions, but overconsumption can lead to sleep disturbances, increased anxiety, and other health issues. Similarly, using alcohol or other substances to unwind after a stressful day of trading can become a dangerous habit, potentially leading to dependency and an array of other health and personal issues. Even habits that may seem harmless or even beneficial at first, like working out, can become detrimental if taken to the extreme. Excessive exercise can be a form of escapism and a way to deal with stress, but it can lead to physical injury and a further increase of stress level if not properly managed. Moreover, these unhealthy habits can exacerbate the emotional toll of futures trading. Over-reliance on harmful coping mechanisms can lead to a cycle of increased stress and anxiety, further compounding the pressures of the trading environment. To navigate the high-stress world of futures trading, it is vital to develop and maintain healthy stress management techniques. This could involve regular exercises, in moderation of course, a balanced diet, good sleep hygiene, mindfulness practices, and hobbies outside of trading. In addition, seeking professional help from a therapist or counselor can provide valuable strategies for handling stress and preventing the formation of unhealthy habits. Some traders may also benefit from joining support groups where they can connect with others who understand the unique pressures of futures trading. It is also important to remember to have friends who are not traders as well. Are you implementing any stress management techniques to help ensure healthy coping mechanisms in your trading routine? Have you overcome any unhealthy habits formed due to trading stress? Sharing your experiences could provide valuable insights to fellow traders on the same journey. Regret and remorse. Trades that result in losses can leave a trader with a feeling of regret and remorse, particularly if the loss occurred from straying from their trading strategy. These feelings can adversely affect a trader's confidence and judgment in future trades. Trading regret, the emotional fallout from losses in futures trading. In the high-stakes world of futures trading, losses are as much a part of the game as gain. When the trader strays from their established strategy and incurs a loss, the fallout is not just financial, it is psychological too. The impact of such losses can significantly alter a trader's confidence, decision-making process, and overall trading performance. Regret and remorse are common emotional responses to loss, particularly when the trader realizes that the loss resulted from a deviation. Regret and remorse are common emotional responses to loss. Particularly, these emotions are intensified by the what-if scenarios that plays out in a trader's mind, What if I had stuck to my strategy? What if I had exited the trade sooner? What if I had not made the trade at all? While it is human nature to experience regret and remorse after making a mistake, in the world of futures trading, these emotions can have tangible repercussions. When a trader is stuck in the cycle of regret, their confidence can plummet. This shaken confidence can, in turn, influence their ability to make clear and rational decisions. They may become hesitant or indecisive, fearful of making another error. This can lead to missed opportunities or, conversely, knee jerk reactions and overcompensation, both of which can result in further losses. Moreover, the lingering sense of remorse can distort a trader's perspective, leading them to focus excessively on their past mistakes rather than learning from them and looking ahead to the future opportunities. This is particularly detrimental in futures trading, a field that requires constant forward thinking and adaptation to market fluctuations. Therefore, managing feelings of regret and remorse is crucial in futures trading. One strategy is to view every trade, whether successful or not, as a learning opportunity. This reframing can help mitigate feelings of regret and instead promote growth and the growth mindset. Another key strategy is to maintain strict adherence to a well planned trading strategy. By committing to a disciplined approach, traders can make decisions with confidence, knowing they are following a plan designed to mitigate risk. Lastly, it is important to maintain a balanced perspective on trading. Every trader experiences losses. It is an inherent part of futures trading. By accepting losses as a part of the process, traders can better manage their emotional reactions and maintain their composure, even in the face of a losing trade. Have you ever felt regret after a trade? How did you manage this emotion? How did you regain your trading confidence? By discussing these experiences, you can offer insights and strategies to help others navigate the same challenges. Psychological pitfalls. Instant gratification. Discuss the common desire among new traders for instant gratification, or the hope of making a lot of money quickly. The Sirens call of instant riches, the desire for quick wins in futures trading. For those new to the exciting and volatile world of futures trading, the lure of instant gratification is hard to resist. Stories of traders making significant profits in a short span of time fuel the dream of quick wealth, turning futures trading into a veritable gold rush for newcomers. However, this intense desire for immediate success, while understandable, often leads to risky behavior, imprudent decisions, and can potentially result in heavy financial losses. The promise of quick riches in futures trading can be attributed to its high leverage characteristic, where traders can control large amounts of an asset with relatively small amount of capital. However, leverage is a double-edged sword, and while it can multiply gains, it can also amplify losses. The possibility of large returns often blinds new traders to this risk. The quest for instant success often leads to overtrading, where a trader eager for quick profits make an excessive number of trades, many of which may be based on impulse rather than informed decision making. Not only does this ramp up trading costs, but it also exposes the trader to an increased risk of loss. Furthermore, the pursuit of quick profits can encourage the adoption of a short-term trading mindset, which can involve a great deal of risk and volatility. It may also lead traders to overlook the benefits of long-term strategic trading, which often involve less risks and can yield steady cumulative returns. Another common pitfall in the rush for instant gratification is neglecting proper research and due diligence. Instead of thoroughly analyzing market trends and economic indicators, eager traders might make hasty decisions based on gut feelings or hot tips, which is a risky approach in the complex world of futures trading. Ultimately, The desire for quick success can push new traders into a dangerous cycle of high-risk trading and potential financial loss. It is crucial to remember that successful futures trading typically involves a carefully planned strategy, patience, and a thorough understanding of the markets. For the experienced traders out there, how do you manage your initial expectations when you first started trading? How do you temper the desire for immediate gratification in your trading strategy? Your insights could prove invaluable for traders just starting out in their futures trading journey. Explain the reality that successful trading requires patience, discipline, and a solid understanding of the markets. It is not a get-rich-quick scheme. Trading realities, patience, discipline, and market understanding trumps quick riches. The promises of quick riches in futures trading can often overshadow the realities of what successful trading truly entails. Contrary to the allure of getting rich quickly, successful trading is usually a long-term endeavor that requires patience, discipline, and a profound understanding of the markets. It is far from being a get-rich-quick scheme, and venturing into it with such an outlook can lead to dire consequences. Patience is the cornerstone of successful trading. The markets do not move in a predictable straight line. Prices fluctuate, trends change, and what appears to be a winning strategy one day might not work the next. Success does not come overnight, but through many cycles of trial and error and learning. Patience enables traders to wait for the right opportunities, adhere to their trading plans, and avoid knee-jerk reactions based on temporary market movements. Discipline, on the other hand, is what holds a trader to their trading plan, ensuring they stick to pre-established entry and exit points, risk levels, and keeping emotions like fear and greed at bay. A disciplined trader recognizes that not every trade will be a winner and is mentally prepared to handle losses. They also know when to walk away to avoid pouring good money after bad. Finally, a solid understanding of the markets is non-negotiable. This involves studying and understanding market indicators, economic factors, and even geopolitical events that could impact asset prices. Without this knowledge, traders are essentially navigating blind, reliant on luck rather than informed decision-making. The truth is that futures trading is a serious and challenging endeavor. It is not a shortcut to immense wealth or an easy side job for additional income. It requires a significant commitment of time and effort, a well-thought-out strategy, and the mental fortitude to stay the course even in the times of market turbulence. For those seasoned traders out there, what was the most valuable lesson you learned in your early days of trading? How did you foster the patience, discipline, and market understanding necessary for successful trading? Sharing your experiences could provide new traders with a much-needed reality check and better equip them for the path ahead. The pitfalls of overtrading. How the pursuit of quick riches can lead to deep losses. The desire to get rich quickly is a siren call that many new futures traders find hard to resist. This alluring promise can lead to harmful trading behaviors like overtrading and taking unnecessary risks, all in hopes of striking it rich. However, this approach often backfires, leading instead to significant financial losses and emotional distress. Overtrading, or the act of making excessive trades without a sound strategy, is a common symptom of the get-rich-quick mentality. The thought process is simple. The more trades you make, the higher your chance of hitting the big, profitable trade. However, this couldn't be further from the truth. Each trade carries a risk, and the more trades equate to more exposure to risk. Overtrading can quickly erode trading capital, especially when transaction costs are factored in. This mentality can push traders to take unnecessary and disproportionate risks. Driven by the desire for quick and significant returns, they may place trades with money they can't afford to lose, or enter highly volatile markets without fully understanding the potential downsides. Such reckless trading can result in devastating losses, often wiping out a trader's account and even plunging them into debt. Remember, futures trading is not a lottery or a gamble. It is a strategic endeavor that requires careful planning, risk management, and market understanding. Quick riches should never be the goal. Instead, focus on developing a robust trading strategy, managing risks effectively, and continuously learning about the futures market. Remember, the goal of trading is not to win big on every trade, but to build steady, sustainable profits over time. Experienced traders, what advice would you give to newcomers drawn to the markets by the allure of quick profits? How did you manage to resist the temptation of overtrading or to take unnecessary risks? Sharing your insights and experience with these could help new traders avoid these common pitfalls and set a course for sustainable, long-term success in the futures market. Risk perception. Discuss the psychological biases where traders underestimate the risks involved in the pursuit of potential profits. Underestimating risks in the pursuit of profits, a dangerous psychological bias in futures trading. In the world of futures trading, a clear understanding of risks versus reward is vital for making sound trading decisions. However, many traders, particularly those new to the markets, fall prey to a dangerous psychological bias, the tendency to underestimate the risks involved in the pursuit of potential profits. This bias, often referred to as optimism bias, is not limited to trading. It is a universal human tendency to overestimate the chances of positive outcomes while disregarding or downplaying potential negatives. In the context of futures trading, this could mean focusing on the potential profits of a trade while overlooking or underestimating the probability and potential extent of a loss. When optimism bias takes hold, traders might ignore warning signs, such as sudden market shifts or risk factors related to the underlying assets, assuming that these potential issues won't impact their trades, or they might hold onto a losing position for too long, convinced that the market will turn in their favor only to suffer substantial losses. This bias is particularly dangerous because it can lead traders to take on excessive risks, believing their trades are safer than they actually are. It is a path that can lead to financial losses, emotional stress, and in severe cases, trading accounts being wiped out. The first step in combating optimism bias is recognizing it. Traders must consciously acknowledge the risk in every trade, regardless of how confident they feel about the potential returns. This involves setting realistic profit targets, establishing firm stop-loss levels, and never risking more than a small percentage of trading capital on any single trade. Psychological biases are significant obstacles in trading, but with awareness, they can be managed. Experienced traders, how have you dealt with optimism bias in your trading career? What steps did you take to ensure a balanced perspective of risks and rewards in your trading decisions? Sharing your experiences could help newer traders develop strategies to manage their biases, leading to more informed and safer trading practices. How have you dealt with optimism bias in your trading career? What steps did you take to ensure a balanced perspective of risks and rewards in your trading decisions? Sharing your experiences could help newer traders develop strategies to manage their biases, leading to more informed and safer trading practices. Explain how this leads to a lack of proper risk management, such as not setting stop losses, risking too much capital on a single trade, or ignoring market signals that goes against their trade. The dangerous downfall, how optimism bias leads to lack of proper risk management in futures trading. In the high-stakes arena of futures trading, risk management is a trader's best friend. However, the optimism bias, a psychological tendency to underestimate risks while overestimating rewards, can blindside traders, leading to significant lack of proper risk management. Setting stop-loss orders, diversifying risk across multiple trades, and listening to market signals are all critical aspects of risk management. However, Optimism bias can make traders ignore these protective measures, convinced that their trades are invincible and will yield profits. This leads to a host of risky behaviors that can quickly turn potentially profitable futures trades into financial disasters. For example, an optimistic trader might forego setting stop loss orders, assuming the trade will go their way. Stop loss orders are designed to limit a trader's loss on a position in a security and are a crucial tool for risk management. By not setting these, traders expose themselves to unlimited losses if the market moves against their positions. Similarly, in their pursuit of significant profits, traders under the influence of optimism bias might risk too much capital on a single trade. This all eggs in one basket approach magnifies the potential damage if the trade fails, risking a large portion, if not all, of their trading capital. Lastly, ignoring market signals that contradict a trader's position is another common mistake induced by optimism bias. Traders might disregard essential market trends, news events, or economic indicators if these signals suggest their trade might fail. Ignoring such signals means traders miss out on crucial information that should prompt a reassessment of their trade. In summary, optimism bias in futures trading can lead to severe lack of proper risk management, exposing traders to outside losses. The key to overcoming this is maintaining a balanced perspective on trading, treating wins and losses with equal importance, and strictly adhering to risk management rules. Traders in the community, how have you kept your optimism bias in check? Do you have specific risk management strategies that have worked for you? Your insight could help guide others navigating through the challenging waters of futures trading. Loss aversion. Talk about the common tendency among traders to hold on to losing positions for too long in hopes that they will turn around, a phenomenon known as loss aversion. Loss aversion, the costly trap in futures trading. In the realm of futures trading, one psychological pitfall tends to ensnare even the most experienced traders: loss aversion. It is the human tendency to strongly prefer avoiding losses to acquiring equivalent gains. In other words, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Applied to trading, this can lead to holding on to losing positions for too long, hoping they'll turn around. Every futures contract involves a buyer and a seller, both speculating on the direction of the market. The buyer is betting the price will rise, the seller that it will fall. Yet, when the market goes against their prediction, many traders hesitate to admit the misjudgment, holding onto the losing position longer than they should. This is loss aversion in action. The loss aversion trap is particularly pronounced in the futures market, given its high degree of leverage and potential for significant swings in value. A small price movement against a position can result in substantial losses. Influenced by loss aversion, a trader may continue to hold onto the position, hoping the market will reverse direction. This tendency to ride out losses often leads to catastrophic results as small losses snowball into significant financial damage. To avoid falling into the loss aversion trap, successful traders often set predetermined exit points for their trades. If a trade hits this stop loss level, they will close the position, accepting the loss as a part of their trading strategy. They understand that not all trades will be winners and that minimizing losses is just as crucial as securing profits in successful trading. In addition, traders can use hedging strategies to protect against potential losses. By taking the opposite position in a related assets, they can offset some of the losses if the markets move against them. How about you, fellow traders? Have you ever found yourself caught in the grip of loss aversion? How do you break free? What strategies do you employ to ensure you do not fall prey to this common pitfall called loss aversion? Explain how this emotional bias can lead to significant losses and erode a trader's capital. Emotional bias in futures trading, a slippery slope to significant losses. Emotional bias in futures trading, a slippery slope to significant losses. Emotions and trading can be a volatile mix. This is especially true when it comes to the world of futures trading, where the stakes are often high and the markets move swiftly. One of the most potent emotional bias that traders grapple with is loss aversion, and it can prove to be a slippery slope leading to significant losses and the quick erosion of a trader's capital. Loss aversion, a cognitive bias where the fear of loss is more potent than the potential gain, can compel traders to hold on to losing positions for far too long in hopes that the market will rebound. This is rarely the case, and if the market does rebound, it's a bad habit to build, and we want to develop good trading habits and not ingrain bad trading habits. This emotional bias often overrides rational decision making and leads to poor trade management, which we are trying to avoid as futures traders. Consider the scenario: a trader takes a long position on a futures contract, expecting the underlying asset's price to rise. However, the market turns and the price begins to drop. Despite the adverse market movement, the trader, influenced by loss aversion, decides to hold on to the position, hoping the price will bounce back. This decision, driven by fear and hope rather than strategic reasoning, can lead to significant financial loss. The market may continue to move in the wrong direction for the trader, resulting in the trader's position losing more and more value. As the trader waits for a turnaround that may never come, the losses mount, rapidly eroding the trader's capital. In contrast, a trader who is not swayed by emotional bias would have predetermined a stop loss in place. The strategy automatically exits the trade at a certain loss level, thus limiting financial damage. The futures market, with its inherent volatility and potential for high leverage, can amplify the impact of loss aversion. Traders can see their capital base significantly reduced or even wiped out due to a series of ill-judged, emotionally influenced Traders can see their capital base significantly reduced or even wiped out due to a series of ill-judged, emotionally influenced decisions. Have you ever found your emotions dictating your trading decisions? Can you recall an instance where emotional bias lead to a poor trading outcome? Share your experience and lessons that you've learned. Remember, it is through shared experiences and discussion like these that we're able to become better traders. Discuss how some traders become overconfident after a series of successful trades, leading them to take bigger risks and ignoring warning signs. Overconfidence in futures trading, a risky road to ruin. One of the most tantalizing and dangerous emotions a futures trader can experience is overconfidence. This inflated sense of one's trading prowess usually surfaces after a string of successful trades, as the triumphant trader begins to feel invincible, leading them down a risky road that could potentially lead to significant losses. Overconfidence can turn a prudent trader into a reckless one. With each successful trade, the overconfident trader starts to credit their success solely on their skill and strategy, ignoring the role of luck, market conditions, or other external factors. They might start to believe that they've cracked the code of the futures market, convincing themselves that they can accurately predict market movements. This illusion of control can prompt traders to take bigger risks. They might start placing larger trades using excessive leverage. In a sense, overconfidence can make traders feel bulletproof, blinding them to the very real and inherent risks of the futures market. Moreover, an overconfident trader may start to disregard warning signs of market signals that goes against their positions. They might ignore stop-loss orders or hold on to losing positions, believing the market will inevitably turn in their favor. This can lead to a poor trade management and significant financial losses. Overconfidence can be particularly disastrous in the futures market, given the market's volatility and the potential for leveraged trades. An overconfident trader can quickly find themselves facing steep losses. It is a harsh reminder that no matter how successful a trader might be, the market always has the final say. Can you recall a time when overconfidence led you to take on more risk than you should have? How did you recognize and overcome this bias? Sharing your experience can help others recognize the signs of overconfidence and help prevent them from making similar mistakes. Point out that overconfidence can lead to poor decision making, excessive risk taking, and eventually financial losses. Overconfidence and its downfall. The pitfalls of excessive risk taking in futures trading. A common trap that many futures traders fall into is overconfidence. Following a string of successful trades, a sense of invincibility can settle in. This self-assuredness, while a great morale booster, can unfortunately lead to poor decision making, reckless risk taking, and ultimately significant financial losses. Confidence is key in trading, indeed, but overconfidence? That's another story. It often springs from a series of successful trading streaks, making traders feel like they can do no wrong. Such a mindset can cloud a trader's judgment, overlooking the role of the market conditions and even luck can lead to an inflated ego. An overconfident trader might start taking larger positions, assuming that their winning streak will continue. They might start straying from their initial trading strategy, dismiss stop loss orders, or hold on to losing positions for far too long, all in the belief that the market will eventually move in their favor, which there is no guarantee that it might. However, as many experienced traders would affirm, the market owes nothing to anyone. It doesn't care how many successful trades you've had in the past. It moves in response to a multitude of factors: economic indicators, geopolitical events, supply and demand dynamics, most of which are outside of a single trader's control. Excessive risk-taking driven by overconfidence can rapidly eat into a trader's capital and result in substantial financial losses. This is particularly true in the futures market, where the use of leverage can amplify both gains and losses. The next time you find yourself on a winning streak, remember to check your overconfidence at the door. After all, humility is a trait often found in the most successful traders. Now, we'd love to hear from you. Have you experienced a blow to your trading account due to overconfidence? How did you bounce back? Your experiences can serve as valuable experience to other traders to help them avoid some of the common pitfalls. The gambler's fallacy. In the gambler's fallacy, the mistaken belief that if something happens more frequently than normal during a certain period, it will happen less frequently in the future, or vice versa. Understanding misconceptions in probabilities in futures trading. The gambler's fallacy, also known as the Monte Carlo fallacy, is a common cognitive bias that surfaces in various facets of our lives, including futures trading. Essentially, it is the misguided belief that if a particular event occurs more frequently than normal during a certain period, it is likely to occur less frequently in the future, or the other way around. This fallacy is named after the notorious event at the Monte Carlo casino in 1913, when the roulette wheels landed on black 26 times in a row. Bettors lost millions betting against black, assuming that the long streak of black meant red was due. A perfect example of the gambler's fallacy in action. But how does this apply to futures trading? Let's say you've noticed a particular futures contract has been increasing in value more than usual over a certain period. If you fall into the gambler's fallacy, you might erroneously conclude that this trend is bound to reverse soon, and you take a short position expecting the price to fall. However, in the realm of trading and investing, past performance does not predict future results. Each trade is independent, and the outcome of one does not influence the outcome of another. Just like a coin flip, where getting heads 5 times in a row does not increase the likelihood of getting tails on the next flip. A futures contract price increasing or decreasing several times in succession does not necessarily mean a reversal is imminent. Understanding and acknowledging the gambler's fallacy can help you make more rational, informed decisions in futures trading. It is critical to rely on the comprehensive analysis and sound strategies rather than misguided beliefs about probabilities. Have you ever fallen prey to the gambler's fallacy in your trading experience? How did you correct this cognitive bias? Share your experiences because sharing this would help others learn from your past mistakes and also help you express your experience as well. Talk about how this fallacy can lead traders to make irrational decisions based on a perceived pattern that does not exist, leading to potential financial losses. The danger of misinterpreted patterns, the gambler's fallacy in futures trading. The gambler's fallacy can lead futures traders down a precarious path. As we've discussed, this common cognitive bias lures traders into believing that if a particular event occurs more frequently than normal within a certain period, it is likely to occur less frequently in the future, or vice versa. Traders, under the influence of this fallacy, might believe that they're spotting a pattern or trend where one does not exist. This can result in costly misstep. In the volatile world of futures trading, perceiving patterns that doesn't exist can have significant financial implications. For instance, a trader might see a futures contract's price rising unusually frequently over a certain period and, due to the gambler's fallacy, decide to short the contract, expecting its price to drop. Conversely, they might see a continuous decline and decide to go long, expecting a rebound. In both cases, the trader is basing their decisions on an illusionary pattern, rather than grounded analysis of the market data. Futures markets, like all financial markets, has a degree of randomness. No outcome is ever guaranteed, and each trade is independent of each other. Falling into the trap of the gambler's fallacy can lead to irrational trading decisions, excessive risk-taking, and potential financial losses. It is essential to recognize this fallacy and instead base trading decisions on comprehensive market analysis, a solid understanding of futures contracts being traded, and a well-thought-out trading strategy. Making decisions based on perceived patterns from a string of outcomes can lead you astray. Have you ever made trading decisions based on perceived patterns that turned out to be non-existent? How did it affect your trading outcome? It would be enlightening to hear your experience and how you've adapted to avoid falling into the gambler's fallacy trap. Facing the psychological challenges. Emphasize the importance of developing emotional resistance, maintaining a disciplined approach, and creating a solid trading plan. Trading tides. The imperative of emotional resilience and strategic planning in futures trading. In the dynamic arena of futures trading, where fortunes can change with a single shift in the market, emotional resistance, disciplined approach, and a robust trading plan are not just advantageous, they are indispensable. Distress, anxiety, and potent mix of fear and greed encountered in futures trading can pose formidable challenges to even seasoned traders. Emotional resilience is your bulwark against these tumultuous waves. It enables you to weather the inevitable storms, maintain composure in the face of losses, and stay grounded during winning streaks. It is about understanding that trading, much like life, involves ups and downs. It is about having the tenacity to endure the lows and the wisdom not to get carried away by the highs. Have you ever experienced significant fluctuations in your emotional state during trading? How did you manage to maintain or regain your balance? Were you even able to? Discipline, on the other hand, is the compass that guides you through the enticing yet volatile seas of the futures market. It is the ability to stick to your trading plan, to resist the lure of hasty decisions or excessive risk-taking. It is about knowing when to enter a trade, but perhaps more importantly, knowing when to exit. It entails setting realistic goals, managing risks wisely, and not letting the fear of missing out, or FOMO, dictate your decisions. Without discipline, you are merely gambling, not trading. Can you recall a situation where maintaining discipline helped you navigate a tricky trading situation? And finally, a solid trading plan serves as your map in the vast ocean of futures trading. It is a comprehensive guide delineating your financial goals, risk tolerance levels, methodologies for market analysis, and strategies for trade execution. A robust trading plan, tempered by experience and honed over time, can be your most reliable ally in your trading journey. Without a plan, you're sailing blind, susceptible to the whims of market currents. How has your trading plan evolved over time? And how has it helped you in your trading journey? In essence, futures trading is not a venture to be taken lightly. It demands emotional resilience, a disciplined approach, a well-crafted trading plan. As you delve deeper into the thrilling yet challenging world of futures trading, may your resilience keep you steady, your discipline guide you, and your trading plan lead the way. In the fast-paced and ever-evolving realm of futures trading, continuous education is not just a suggestion, it is a necessity. Knowledge is your greatest tool and ally, and a comprehensive understanding of market dynamics and psychological biases is paramount for consistent success. Futures markets are complex, dynamic ecosystem influenced by an array of factors ranging from macroeconomic indicators to geopolitical events. To effectively navigate these markets, you need to stay up to date and updated with market trends, understand the intricacies of contract specifications, and interpret data from charts and indicators. Moreover, as the markets evolve, so too should your knowledge and strategies. Therefore, investing is a continuous education. Whether through reading, online courses, webinar, or memberships, it's crucial you continue your education. Does anyone have any favorite resources that they would like to share? Yet, being a successful trader is not just about understanding the markets, it's equally about understanding yourself. Trading will be the most difficult thing you have ever done. It challenges you, it constantly challenges you. It tests your biases, and it's equally about understanding yourself, your instincts, your biases, your emotional responses. Trading can often be a psychological tug of war, where rational decisions can be clouded by fear, greed, or overconfidence. By educating yourself about common psychological biases like loss aversion, the gambler's fallacy, overconfidence bias, you can cultivate the self-awareness needed to make informed, objective trading decisions. It is about knowing when your judgment is being swayed by emotions and having the discipline to stick to your trading plan regardless. Can you recall a time when you noticed a psychological bias influencing your trading decisions? In conclusion, futures trading is a journey of constant learning. It is about staying informed, staying adaptable, understanding not just the movements of the markets, but the movements of your mind. With continuous education and self-awareness, you can sail with confidence and agility in the dynamic seas of futures trading. I advise viewers to seek support either from a mentor, trading community, or psychological professional specializing in trading psychology. Harness the power of community and professional support in futures trading. In the high-stakes, often isolating world of futures trading, seeking support can make all the difference. There is no need to walk this journey alone. Mentors, trading communities, and professionals specializing in trading psychology are invaluable resources that can help you navigate the futures trading landscape with greater confidence and resilience. A mentor, particularly one with a proven track record in futures trading, can provide personalized advice, guidance, and encouragement. They can help you understand the ins and outs of the futures markets, offer strategies and insights drawn from their own experiences, and provide a fresh perspective when you're too entrenched in your positions. They can also help you hold onto the discipline and patience needed in trading, particularly during tough times. Do you have a trading mentor, or have you considered finding one? How has mentorship helped your trading? Likewise, being a part of a trading community can offer both learning and emotional support. Trading communities, whether online forums, social media groups, or local clubs, allow you to share insights, discuss strategies, and learn from a diverse range of experiences. More importantly, they provide a sense of solidarity, reminding you that you are not alone in facing the ups and downs of futures trading. What trading communities are you a part of, if any? How have they helped you? Or maybe they've been a hindrance and teach you bad habits. Share your experience. We'd like to hear about it. Finally, psychological professionals who specialize in trading psychology can provide targeted support to help you manage the emotional challenges of trading. These professionals understand the unique stressors that traders face and can offer coping mechanisms, resilience building strategies, and techniques for emotional regulation. They can help you understand how your emotions impact your trading behavior and guide you in making more balanced, rational decisions. Do you have a psychological professional that you talk to? Have you ever considered a psychological professional for trading support? Remember, futures trading is not a solo endeavor. By seeking and utilizing support, you enhance your learning, fortify your emotional resilience, and position yourself for a more successful and enjoyable trading journey. If you've watched the video all the way to the end, I could tell that you really want to be a profitable futures trader. If you're watching this video on YouTube, scroll to the bottom of the description. There's a link where you could fill out the form. Once you fill out the form, you'll be entered for a special giveaway. Thank you for listening, and this is just for you.